We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Wojcicki. Joining me today is Lyn Alden, founder of Lyn Alden Investment Strategy, available at lynalden.com. How are you today, Lyn?
I'm good. Thanks for having me. Lots to talk about.
Great to have you back. I wanted to start by talking a little bit about the debt cycle and how this would typically be shrinking during an economic expansion. So what has been happening since 2016, and how did the pandemic really also affect this condition?
Yeah, so normally in a recession, you see a private sector deleveraging and a public sector increasing their leverage, right? Because you have kind of public funds coming in to shore up unemployment and things like that, while a lot of weaker companies start going bankrupt, and bigger companies cut down on hiring and try to shore up their balance sheet. And so this cycle's been quite odd because we haven't really seen a lot of deleveraging. We've had a very compressed time frame. But we've still seen, of course, the massive explosion in public leverage. And so, we've seen, a sharp, a rebound in a lot of asset prices, but we still, going forward, we still have a credit cycle playing out. So we still have many weaker companies, going bankrupt or being impaired. And that's going to take probably all of 2021 to sort out. And, going back to 2016, it, depends on what time frame you look at. So we saw, when the dollar became strong in late 2014, early 2015, that caused kind of a slowing growth worldwide, especially in emerging markets and especially their commodities demand. And so that's where we kind of saw a pretty big pullback, especially in the natural resources sector. And then since then, when we had a weaker dollar, throughout 2017, we had a global rebound and more liquidity conditions, and but that rolled over in mid 2018. And so we re-entered a strong dollar environment. We started to get slowing global growth, declining GDP growth rates. And of course, that came into a climax this year when we also got hit by the pandemic, and that kind of put the cherry on top and had a stepwise down function. And so, going forward, we still have this winter to get through. But I think as you look into late 2021, the global economy starts to look like it heats up a little bit, especially in terms of commodity demand.
Another interesting correlation that is kind of tied to these debt cycles that I know you recently brought up is the fourth turning cycle. So tell us a little bit more about what are some types of the things that happen during the end of this cycle, and especially during the fourth turning, as it's been called.
Yeah, so basically we're all familiar with the short-term business cycle, which is the 5 to 10 year credit cycle of boom busts. But every time there's the end of one of those cycles, we have a deleveraging event, and then we have policymakers come in, they cut interest rates, they do all sorts of fiscal spending, and they kind of short circuit that deleveraging. So the private economy never really deleverages as a percentage of GDP back to where they started that cycle. And so they only do a partial leveraging, let's call it halfway, and then they start building up leverage again. And so when you string multiple of those business cycles together over multiple decades, you get higher highs and higher lows in terms of debt to GDP. And you get lower lows and lower highs for interest rates. And that's what allows them to have more and more debt. But that starts to run into issues once you hit zero rates, or in recent times, even mildly negative rates in some countries. And because there's not a lot of policy room to keep cutting rates, and debt is extraordinarily high at that point. And we have to look back all the way to the 1930s and the 1940s to find the last time that this happened, where we kind of ran into the zero bound with extraordinarily high debt levels. And that's what's been called the long-term debt cycle. So Ray Dalio and others have popularized that term, and it's something that I've incorporated into my research pretty heavily. If you then look at Neil Howe's work, the demographics, the history specialist, in his book The Fourth Turning, he showed that basically every 80 years or so, you have a really big kind of change in the way societies function. You kind of tear down old institutions and rebuild up new institutions. It's usually a very, very difficult time period. I don't know if he knew it at the time, but all those fourth turnings line up with long-term debt cycles. It's just kind of how it works out, where we have kind of a and what separates a long-term debt cycle from a normal short-term cycle is that a long-term debt cycle is normally associated with currency devaluation. And so basically debts get so high that policymakers can't deleverage them without the system collapsing. And so usually you have a rapid expansion in the money supply, and you basically devalue currency so that you take away some of those debts in real terms, but not nominal terms. And that's historically what we've seen, and it's already kind of playing out that way in this cycle as well.
Mhm. So as we're talking about, lowering interest rates, even getting to negative interest rates, and the amount of printing that we've seen and the amount of debt, can you define for our listeners maybe that just to make it a little bit clearer, what's the difference between monetary policy and fiscal policy?
Yeah, so monetary policy is involve things like controlling interest rates, manipulating interest rates, as well as asset purchases by the central bank. So if the central bank creates new bank reserves and uses those to buy, treasuries or mortgage-backed securities, or in recent cases, corporate bonds or things like that, that's monetary policy. Fiscal policy is things like how much to tax, how much to spend, whether to do a stimulus spending, and that's authorized by Congress. But normally what happens also at the end of long-term debt cycles is that those two start to merge. And so if we look back into, World War II, for example, at the end of the previous long-term cycle, the 1940s, you had massive fiscal deficits, but because they were so big, there's so much debt that there was no one really to buy all those treasuries. And so the central bank bought a lot of those treasuries. And so you had that kind of, I've referred to it as wartime MMT. Like you had that kind of blending of fiscal and monetary policy. And you also had, the central bank do yield curve control to make sure those yields stay, unfortunately, below the inflation rate. So anyone holding on to those treasuries for the long term, they got their money back, but that money was devalued. And so this year, for example, we again saw massive fiscal spending. A lot of those treasuries were bought by the Federal Reserve because their foreign sector wasn't really buying, and the domestic sector can only absorb so much. And so we had the central bank create new bank reserves, buy a lot of that fiscal treasury issuance. And in addition, like at the aforementioned corporate bond purchases, they were only possible because they were authorized by Congress. So basically, the Treasury and the Federal Reserve opened up a special purpose vehicle to buy corporate bonds. And so that those sort of weird exceptions tend to happen at the when the system starts to break down at the end of these long-term debt cycles.
So as we know, the virus has really caused deflation in some sectors and inflation in others. So when we're having these pressures exerted on different parts of the economy, in your view, when are we going to get the inflation that the Fed is after, and what is going to be a consequence of them actually being able to get the inflation that they're after? Is it going to get out of hand once it actually starts the way that they're measuring it?
So I think that, there's a handful of catalysts, and I've covered a number of them. I think the catalyst that I'm most heavily focusing on is commodity scarcity. And the reason for that is, it's hard to get broad inflation if commodity prices are low. And so if you look at energy prices, or industrial commodity prices, many of them are at the same price they were 10 or 15 years ago in dollar terms. And so basically, we had that period of oversupply. And so a lot of those commodities have just been very cheap. And that's, it's shown up the most in the energy sector. And we're starting to see some breakouts in some of the metals. Now, precious metals were the only ones that really kind of, went against that trend because they're generally the first to move. Whereas those broader, building blocks into the economy, those industrial commodities and energy, they've been very cheap. And so I think the key turning point for inflation is when you start to get, instead of oversupply, you start to get a tighter supply demand balance. And I think as you look out a couple years ahead, so after we have this kind of this winter period where shutdowns are happening again, and there's not exactly a ton of demand at the moment. But I think as you look out into late 2021 and in 2022, you start to get a big rebound in commodity consumption after already having pretty significant supply cuts, especially in energy. And so I think that's where you can get more inflation. And then from there, the key risk is that unlike the 70s, the Federal Reserve won't be able to raise interest rates to keep inflation in check, and that's because sovereign debt is so high that would cause a fiscal crisis. And so in that way, it looks a lot more like the 1940s, where even though inflation at times reached the double digits, the Federal Reserve basically capped treasury yields by being willing to print money and buy them to peg them. And so, but because the market always wants to express itself, like the Fed can't control the market, it can only redirect the market. It's like you can't stop a river, you can change the flow of the river. And so when they cap yields, if they get to that point, then it shows up in currency devaluation instead. So, relative to other currencies, or because many countries are doing it more broadly, it's a devaluation of currency relative to hard assets such as commodities, such as real estate, things like that.
So when we're going to get, as you said, the devaluation of the currency, you recently wrote an awesome article and updated this great big article about the fraying of the U.S. global currency reserve system. So can you highlight to us why you're so bearish on the dollar long term, and tell us more about the factors contributing to the dollar's demise, please?
So a couple things. One is even just looking out over the past 50 years of what I've called the petrodollar system. That's the common term for kind of the system we've been in ever since the early to mid 1970s. And back in the beginning of that period, the United States was nearly 40% of global GDP. And they made deals with oil producers so that all of the oil production was priced in dollars. So even if Europe buys oil from Saudi Arabia, they pay for it in dollars, even though it's neither of their currency. So we've had a de facto, backing by oil for the dollar over the past 50 years. So in that sense, it's only been partially a fiat currency. It's been even though it's never been pegged to oil, it's essentially backed by oil because every country in the world pretty much needs dollars if they want oil. And but over time, that's caused issues because the dollar has these, really big kind of 15-year bull and bear cycles based on major shifts in monetary and fiscal policy. And so a lot of countries, they have dollar-denominated debt because emerging markets can't get financing in their own currency, so they often get dollar debts. And whenever you have the dollar strengthen relative to their currencies, you generally get a, kind of a currency crisis and an economic slowdown. And likewise, whenever you have a dollar bear market, you tend to get that international boom, from Latin America, from Asia. Usually it comes along with a decent commodity cycle as well. And so for the past 5 years, we've been in one of these strong dollar periods. And so, we've had ups and downs during that cycle, but overall, if you look at the really long-term 50-year chart, we've been in, what is the third, dollar bull period. And so, regardless of any long-term structural changes, mainly just due to recent shifts in fiscal and monetary policy, I expect a dollar bear market over the next, call it 3 to 5 years. And that's a view that I've held since autumn of 2019. And so far, we've had some degree of dollar devaluation relative to a basket of foreign currencies, but nothing particularly major yet. So I don't really have a firm outlook for the next 3 months or 6 months, but I think the next 3 to 5 years are still looking likely down for the dollar. And then longer term after that, one thing I'm watching is that the world is starting to go around that petrodollar system. And that's because, at the beginning of the system, the US was 40% of GDP. Now it's 20 to 25% of global GDP. And so there's really not a lot of dollars out there in the system for all these countries in the world to use dollars to buy oil. And now actually China is a bigger importer of oil than the United States. And so we see, some of these countries start to go around the dollar system. So China and Europe and Russia, for example, have partially de-dollarized their trade. So if you look at the trade between China and Russia, the exports of Russia to China, which are very much commodity based and energy based, those used to be almost entirely dollars. But now they pay in a combination of dollars, euros, and their local currencies. Same thing for if you look at Russia and Europe, that's increasingly become more euro focused and less dollar focused over time. Same thing also is true between Russia and India. And so over the next several years, I expect to see more and more of those alternate payment channels. So we start to see a more multipolar currency world. And so instead of having like one global reserve currency, we're increasingly shifting to, kind of multiple regional currencies where you have the dollar, you have the euro, potentially China's currency, and you have a couple of these major currency blocks, and those currencies are able to buy oil.
So what is the end game? Obviously, I know that timelines are very important for you here. And so not necessarily thinking about a specific timeline, but is the likely end scenario a currency devaluation or restructuring as a result of this?
Yeah, I think so. I think this, both during the end of a long-term debt cycle and during a shift in a global monetary system, you tend to get a currency devaluation. And so the previous long-term debt cycle was the 1940s, and the previous shift in the global monetary system was the 1970s. And so this is actually in some ways both of them happening at the same time. And so that exact order can vary, especially because the global monetary system is currently changing around the margins slowly over the course of years rather than a big kind of shock all at once. And so I expect a currency devaluation from both of those forces, and especially when taken together, that's generally a period where you see hard assets do pretty well and fiat currencies lose value relative to those hard assets.
So when we take this into consideration, Lyn, obviously we want to try and protect, let's say, the purchasing power of the currency we have. So taking a, let's say, 3 to 5 year outlook for our investments, how does this help us simplify when we're looking over this a little bit longer term than most people would think about? So explain to us how this helps your thinking simplify and really identify where opportunities lie for a good investment there.
Well, so partially what I'm tracking is the bottlenecks, right? So understanding why growth has been sluggish this decade across the world. And a lot of it has to do with the fact that that dollar system is no longer working very well. So the whole world needs dollars. There's not enough dollars outside of the US, right? So all those offshore dollars, they're just not circulating as much as they used to, in large part because the US is just not big enough to supply the world with that many dollars. And so understanding that bottleneck and understanding kind of the release valves for how that can be released can help us potentially see the next leg of global growth as we get deeper into the 2020s. But instead of being a global growth with no consequences, that global growth is likely to come along with a weaker dollar and more broadly devalued currencies across the board. So the euro, the yen, devaluation in all these kind of highly indebted currencies. And so long term, basically that helps inform my view for things I want to invest in, like whether I want to invest in global equities or U.S. equities, whether I want to invest in commodities, or if I think they're still going to be in a prolonged bear market. And so that kind of shapes my view. And at the current time, it's favorable towards foreign equities broadly. I like to handpick individual equities where possible. So I like both certain U.S. equities and foreign equities, but in general, I think some of the foreign indices are going to do pretty well. And I also still like a variety of commodities, including precious metals, including industrial commodities, and even including digital assets like Bitcoin.
So when exactly when you're saying talking about going into the future, and we think about the the green economy that we're or green energy generation that we're trying to deal with going forward, obviously silver is going to be a huge winner in that environment, correct? And that's why you think that silver has a great opportunity to do well in the next, let's say, 3 to 5 years.
Yeah, I think so. It can benefit both from its monetary side. So as you get a currency devaluation, silver can get a bid, and then as well as for its variety of industrial uses, a lot solar panels, electric vehicles, electronics more broadly. And so I think that's one of the metals that has a well-known kind of long-term supply demand favorable situation. Same thing with copper, same thing with uranium, same thing with a lot of these key ingredients for future as we diversify our energy mix and get more and more kind of electricity based power. So having more and more kind of a grid, stronger grids, like you need copper, and as we get kind of electrical vehicles continue to slowly take market share.
So, Lyn, in your opinion, what are some of the better ways to be playing let's say, the silver space? Are you buying individual equities, or are you buying, like, let's say, an ETF to kind of broaden that risk out?
A little bit of both. So, I hold silver directly. So it's one of the metals you can hold in physical possession or in vaults. There's also some physical ETFs or closed-end funds that can hold it. So I like direct holding, and then as well as I do also like to have some leverage with the miners as well. And I've incorporated both ETFs and individual names. Now, because I take a pretty top-down approach, I don't go deep into individual miners too heavily. So there's a handful that I track. But there are certainly specialists in the field that cover silver miners with far more kind of individual rigor than I do. Whereas, when I go deep into companies, it tends to be in other sectors because the mining sectors, it's very specialist.
Mm-hmm. So, do you take the same approach when you're looking at the way that you think about gold?
Yeah, pretty much. I emphasize a handful of companies that have quality metrics that I like. So I like the royalty and streaming model. And then to a lesser extent, I do also go into individual miners as well. But then I also get some broad exposure with some of the ETFs just to have kind of a, a broad macro-based play on the sector without taking on too much, independent company risk. But then for investors that like to go down into the weeds there, there are people that can go deep into why one company might like dramatically outperform another company. And
Mhm.
like I said, I incorporate some of that, but it's not kind of my core area of focus.
Excellent. So you talk a lot about knowing your own strengths and weaknesses. So can you give us some guidance around how to start taking some profits and tools that you use to help yourself to inform these decisions?
Yeah, it really depends on the asset class. And so, for example, with equities, especially outside of the natural resources sector, I often use tools like fast graphs, for example, where they let you compare the stock price to the underlying fundamentals and the historical average valuation. I use Y charts for analyzing balance sheets or analyzing different types of valuation metrics. And so, when companies get notably above my valuation preferences, I begin to rotate out of them. And also, yeah, I have to define it. I have to define like another area that I want to rotate into. And so, for example, earlier this summer, I was rotating out of some of my high performing tech stocks like Adobe or Nvidia, and I was going more into the global energy plays. And so, I basically rotating out of something that did very well, but that in my opinion became quite pricey, into something that recently has done very poorly, but was so bombed out in terms of valuation, and it still has likely a good recovery period left to it when we look out over the next several years. So I like to rotate there, and I look at things like overbought or underbought indicators, MACD, kind of really basic technical things, just to see when momentum seems to be shifting.
So exactly as you're talking about trying to identify these sectors that are underbought, let's say at the time. Let's talk about a framework that you try to build to determine where those opportunities lie and where you would be happy to invest your money, even if it drops another 20%. Just those places that you are able to really find that opportunity.
So for example, gold's that opportunity at the moment, because I have a specific model for gold where I track the growth of the broad money supply and real interest rates. And because those are the two kind of major variables for what dictates gold price over the long term. So the very long term, gold tends to keep up with the rate of broad money supply per capita, just because basically dollars being created and devalued relative to gold. You can think of it, but it tends to fluctuate in shorter increments against real interest rates. And so, because we had this summer we had some overbought conditions in precious metals, and we had a shift where real rates were declining; they were getting deeper and deeper negative, and they started to rebound a little bit because we've had an increase in some treasury yields, and so we started to get a pullback in gold. And I still think the long-term, situation is favorable, but it's been under some near-term pressure. And so whenever we get these kind of pullbacks in precious metals, I'm still quite bullish when I look out with a 3 to 5 year view. And that's an example of something that even if it were to fall 10, 20%, I'm a buyer of that dip because I still think the fundamentals look pretty good. I think that's kind of a key reason to have a process or kind of a base that you come back to see, instead of just looking at price, you're looking at price relative to certain models that you use, for companies that, that can include their earnings, their cash flow, their balance sheet strength, their historical valuation metrics. And whereas for commodities or precious metals, you need some other tactics, but it still ultimately comes back to fundamentals.
So when we look at these fundamentals, as you're saying, Lynn, do you think that undervalued model applies to basically most of the commodities generally right now?
Well, to some extent. So gold's special because it's a almost a pure monetary metal.
Mhm.
So most of its value is for investment and for jewelry, and with a much smaller share goes to industrial usage. And it has a very high stock to flow ratio. So year to year production is less important because there's so many decades worth of above ground gold. And so it's a lot less tied to supply and demand than industrial commodities. And so I value it. It's the one that all of them, compared to all of them, it follows that pattern of tracking with broad money supply and real interest rates more closely than the others. For some of the others, I compare them to money supply just to get an idea of how historically cheap they are. But they kind of their timing is a lot more dependent on the supply and demand characteristics because unlike gold, they're not stored, years and years and years in advance. You might have months of storage, you might have a year of storage, but you don't have 50 years of storage like you have with gold. And so when you get a sharp decrease in demand, or you get a supply disruption, you have those. That's why industrial metals tend to be, more volatile, more cyclical than precious metals.
Perfect. So as we're talking about storing things for long term and the monetary value of gold, something I'd like to get your opinion on, that we've been going through back and forth on the show here lately is Bitcoin. So what is your outlook on Bitcoin, and if you can give us some, let's say, different ways to think about it than normally we would get from the let's say gold bug community?
Yeah, sure. So I'm bullish on Bitcoin, alongside my various precious metals and commodities bullish view as well. And so I covered it back in 2017, and I was not bullish then. That was late 2017. We had a lot of euphoria back then, and we had some specific fundamental issues that I was uncertain on. And so I avoided the industry then, and I was much more bullish on precious metals. And then when I covered it again early this year in April, I became very bullish on it because a lot of the initial concerns I had were addressed. And so basically, you can think of one of the biggest hangups that precious metals have with digital assets is that, when you look at precious metals, there's only a handful of them, right? You have gold, you have silver, you have platinum, maybe, and you don't really have. There's only a handful of precious metals. They're all scarce, and there's no way to make another precious metal. Whereas digital assets, even though any individual digital asset might be scarce, like Bitcoin's never going to have more than 21 million coins, anyone can copy that and create a cryptocurrency. Ever since Satoshi figured out how to do it and solved all the hard parts, now anyone can do it. And so there's literally thousands of cryptocurrencies. So the big question is, what makes one valuable if anyone can just literally copy Bitcoin or copy Ethereum and just make more and more? And the answer to that question largely has to do with the network effect. And so with Bitcoin, for example, there's over 10,000 nodes around the world that are verifying Bitcoin transactions. And the actual estimates are far higher than that, but there's over 10,000 that are visible to the network. And that's far more than any other digital asset. In addition, that is far, orders of magnitude more mining hash rate that goes into it. And so basically, Bitcoin has far more security, far more network effect than any other digital asset. So in a similar way that if you were to take, Wikipedia and just copy it, and you wouldn't get the same billion traffic views that Wikipedia gets, because it has all the search links pointing to it. It comes up the top in every Google search you do. It has that strong network effect that even a copy of Wikipedia wouldn't have. Similar thing, like if you were to build your own social platform, good luck competing with Facebook or competing with some of these others. And so basically Bitcoin established itself so much that there's so much surrounding ecosystem for it, and there's so many nodes and so many miners that are so heavily focused on it, that particular one has developed a very strong network effect. And so when you have that network effect combined with the fact that there's a scarce number of units, that tends to do very well when currency gets devalued.
Perfect. So even at these levels, do you think that that it is overbought, or the sentiment is too high on it right now?
I think it was about a few weeks ago. And so back in November 22nd, in my research service, I did warn that a correction was quite likely.
Mhm.
And so I wasn't sure if it would take the form of a consolidation or a correction. So it could just go sideways for a while. It could correct. And so since then, we have seen more volatility and turbulence. And that's kind of natural because Bitcoin's been testing its previous all-time highs. And so it has that resistance level. And plus, it had a really strong, several months here. And so it kind of reached near-term overbought conditions. But if you look back at previous Bitcoin bull runs, they tend to have multiple near-term periods of overbought conditions and then corrections, and then they resume that bull run. And so when I zoom out, looking at the full chart since Bitcoin's inception, and especially I look at it in log form, right? Because the linear chart doesn't really give you much information for an asset class that has grown so much. You really have to look at the log chart. And so especially when you take into account the Bitcoin supply halving cycle and things like that, I still am quite bullish on it looking out through 2021. We're going to have corrections along the way. And I think a key level to watch is 20,000, because until it breaks, firmly above 20,000, it's vulnerable to more and more consolidation corrections. And it could take, a month or more to break out potentially. And there's always a possibility that it fails to break out. But once it breaks firmly, like decisively above 20,000, that there's nothing but air up there, right? And so you have really good supply demand fundamentals at the moment, and once it clears that resistance, I'm pretty bullish on it.
Excellent. So as we wrap up here, Lyn, is there anything else you'd like to add?
No, I think that pretty much covers it. I think the next few months are going to be really uncertain for a lot of asset classes, just because stocks are arguably overbought here, and we've had kind of a period of rising real rates, but lately it's been kind of stagnating and uncertain. And we have, we're going into a winter. We have a lot of shutdowns happening, and so I wouldn't be surprised to see corrections in a variety of otherwise good assets. And so that includes some of these energy assets. That includes some of these copper assets. Some of them have come really far, really fast. I wouldn't be surprised to see corrections, but for investors that are looking out into late 2021 or into 2022. I think a lot of these scarce assets are good to own, particularly on pullbacks.
Perfect. That's some excellent advice there, Lyn. As always, we can find you at lynalden.com and at Lyn Alden Contact on Twitter. Lyn, thanks very much for your time today.
Yep. Thanks for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.